The taper tantrum is back. The taper tantrum is back. But what is the taper tantrum, ladies and gentlemen? We're going to ask Jeff Snider, the head of global research at Alhambra Partners, what it's about. Why is the taper tantrum back? Well, according to the Financial Times, by Mr. Richard Bernstein in an opinion column just this week, February 24th. Here's the title of it in case you wanted to read it, ladies and gentlemen. Fed needs to ignore taper tantrums and let longer rates rise. Central bank should take its cue from a baby sleep training technique. Let me read a few pages, just a paragraph here. The Ferber method, not to be confused with the Ferbus general equilibrium model, which we discussed in episode 35, part 2. Okay, the Ferber method, a sleep training technique, teaches babies to self-soothe and fall asleep on their own. It's as much a training technique for new parents to ignore their baby's crying as it is for the child to learn to cope by it themselves. The U.S. Federal Reserve should consider Ferberizing bond investors and ignore future taper tantrums like the market disruption that occurred when the central bank signaled tighter monetary policy in 2013. The long-term health and competitiveness of the U.S. economy may depend on bond investors' self-soothing ability to cope with reality. Jeff, we're going to talk about the taper tantrum right now.
No. We're not going to talk about the taper tantrum because there was no taper tantrum, and this is all wrong. Bond investors aren't panicking. They're looking at the future and saying, hey, it doesn't look as bad as we thought. We want interest rates to rise. Everybody wants interest rates to rise. That's the point here. Rising interest rates are not an awful imposition. They're the signal that things are working. Things are going in the right direction. Again, interest rate fallacy. Rising interest rates are bond market investors selling the safe liquid stuff and presumably doing more risky stuff with their funds, which is what we want them to do.
Yeah, exactly. And so you bring up what the taper tantrum was versus what it is.
Everybody says the taper tantrum in 2013 was because Ben Bernanke said the word taper. When he never actually said the word taper, by the way. Then it doesn't really matter. What he said was in May 2013, well, this QE we said QE4 was going to go on forever, QE3 and QE4 that started in 2012. But things look like they're improving, so maybe we won't need to do QE forever. And the bond market took that cue and said, oh, maybe things are improving. When in the media, and according to economists and central bankers who control the yield curve, it must have been the yield curve reacting to instructions from Ben Bernanke. No, what the bond market was saying is, we agree with you, Ben. We kind of think things look like they're improving and not getting worse as we feared earlier in 2013. And so we're going to sell some of our safe and liquid instruments and start buying some more risky stuff, which is what we wanted. Except the problem was, come 2014, they started buying the safe and liquid instruments all over again, and nobody could figure out why. That's really why we talk about the taper tantrum, is because we can't figure out the other half of it. And the other half of it was false dawn, failed recovery, no inflation. And so what's happened is, well, maybe the rising interest rates choked off the recovery before it got going. And that's really reverse engineering from the position of, well, the Fed controls the yield curve, therefore, why would it go back down in 2014 when it should have kept going, when rates should have kept going upward? It's really misunderstanding the fact that the bond market is independent of the central bank.
How dare you, that last point? How dare you make that last point?
Blasphemy, right?
A couple of points, ladies and gentlemen. I'm going to go back a little bit, just a couple of points. You heard Jeff Snider just say QE4, and you're like, well, guy doesn't even know what he's talking about because there was no QE4 until recently. It was QE3. Ladies and gentlemen, as we explained before, just because they don't call it QE4 doesn't mean there weren't 4 QEs by the time the taper tantrum began. Jeff, you're welcome to talk about it that if you want to. If not, I'm going to go on to my other point. The other point is the reason we're discussing this taper tantrum is because Jeff wrote an article at Alhambra Partners blog post, and it was posted on the 22nd of February, and it was called What Might Be Another Market-Based Yield Curve Twist, because the yield curve is twisting, it's spreading, right? It's getting wider. And so We already discussed the first two reasons why that might be. In episode 45, part 1, we gave one reason, well, Jeff explained, that it might have something to do with non-performing loans and the possibility of rating downgrades for banks. Episode 49, part 2, we gave a technical reason that it might have something to do with the upcoming cliff, quote unquote, and the supplementary leverage ratio, capital ratios, that sort of thing. So now, Jeff, you are giving a third reason, and that is by going back in time and looking at the Taper Tantrum, and you quote your articles from about that time, 2014 and 2015. You quote 3 of them, Jeff. In there, you talk a lot about the mortgage bond market. Just tell us a little bit more what was happening with mortgage bond securities, something called the TBA market, and how there might have been a collateral squeeze and a run, and that was involved with the Taper Tantrum.
Well, before we get to that, let's be clear about when we're talking about the yield curve twist here. It's the opposite twisting of what the Federal Reserve at least attempted to try to tell the public it was doing with what it called Operation Twist. When the Fed attempted to do Operation Twist in late 2011, it was trying to sell bills and buy bonds, which was to twist the curve so that the short end would kind of come up and the long end would stay pegged at where it was. That was the twisting they were attempting to happen. And that's really what Richard Fisher, as we talked about in our last episode, that's what he was really saying when he said, why are we buying assets that people are already buying themselves? Now, the twist we're talking about in 2013 and again in 2021 is that short-term rates have fallen at the same time long-term rates are rising. So the curve is twisting in the opposite way. And if we had talked about, if this was a real recovery, we would expect the curve to behave a little bit differently. We would expect the entire nominal curve to start really shifting, maybe much less at the front, but we wouldn't expect the bill rates to fall towards 0. And in fact, when you go back to the 2013 twist, the same thing happened then too. It wasn't just that long-term nominal yields were rising, as they were. They rose actually more quickly then than anything we've seen today. But the bill yields were falling, and they had been falling since February of 2013, which is something we talked about before in previous episodes with repo fails and all the stuff going on in the repo market. So we have this twisted curve in 2013 showing up too.
No, keep going. I'm going to show a graph that shows this taking place, but you keep talking.
Yeah, okay. So when we talk about another thing that happened in June of 2013 was that as the Treasury market was selling off, the MBS market really got, I mean, we're talking about a real massive rout in the MBS market late in June of 2013, which really kind of created more of a situation where we start to bring our attention to repo and collateral and things like that. And the reason is because of how MBS is put together, how the MBS market works. And when you're securitizing, not just a mortgage bond, but any kind of securitized security, you're pooling assets together and then creating structures off of them. So it's not like you're putting it together on day one and then selling it to investors. You actually have to pool up a bunch. In this case, you have to create a pipeline of individual mortgages that you can sort out, put them together by similar characteristics, and then package a pool together into an MBS security that actually you've pre-sold into the market, something called a production coupon, so that you actually have to have a steady pipeline of mortgage loans into this TBA market in order to eventually create this mortgage bond that you've actually already sold to investors. And while you're pooling all these mortgages together, you have certain obligations, certain risks, certain funding. And that we talked about SOFR before. This is one reason why SOFR is completely useless. It doesn't help you in the TBA market as you're pooling together mortgage loans and maintaining what you hope is a steady pipeline of reasonable mortgages.
So the originator, right, or the securitizing firm, they promise to deliver a package in the future, and in return they get some sort of some sort of support from eventually the Federal Reserve. Is that what was happening at the time? And the problem is if there is some sort of disruption in the mortgage market, right? Or as you explain here, in the demand, maybe people aren't getting as many mortgages as they wanted, so the supply isn't available. All of a sudden, you're unable to deliver what you promised you were going to, and there are fail-safes for that, contingencies, but that may have been a broad systemic problem, and so people are running. Go for it. Yeah, go.
No, I just say mortgages are a messy business, right? I mean, because people, they start a mortgage application. I mean, it's not just, you don't get a loan tomorrow. You start an application, maybe you don't finish it, maybe you don't qualify, maybe you get close to qualifying and you don't close. I mean, there's any number of factors that happen. And so you always have to juggle all of these things in the mortgage pipeline. At the same time, you have to have financing in place because you're giving out mortgages. And so the pipeline grows, it shrinks, it's a dynamic marketplace. The funding market, this TBA market, is a dynamic place. Sometimes the Federal Reserve comes in because it wants to stimulate more activity. There's all sorts of stuff that goes on there. And of course, because this is finance, this is the way things are done in the modern world, it's collateralized. These things called dollar rolls, which essentially act as a repo collateral. So as you were pointing out, when you're putting together a mortgage structure, you're sort of pre-selling it, you're sort of committing yourself to deliver a certain amount of mortgage loans and funding those loans until you deliver those loans. What happens, for example, if you've promised to deliver $1 billion in mortgage loans, but you can only find half of that many because the pipeline dried up? Now all of a sudden you're committed to deliver all these loans, but you don't have loans, so you have to go in and fund. You have to find some funding elsewhere to keep yourself in business. You have to satisfy your production coupon at the same time. You have to find replacements, dollar rolls that could essentially fulfill your obligations. In other words, you have to have the collateral to borrow to be able to keep yourself in the business long enough until this pipeline problems are dealt with. And in the middle of 2013, we had one of the sharpest interruption in mortgage business that we've seen in a long time, because of interest rates rising quickly. Essentially, people stopped. They stopped applying for refinancing mortgages and for purchasing new homes, and so the pipeline interruption definitely spilled over into other parts of the financial system.
If the economy was healthy, they would have been able to afford that rise in interest rates. That's the key point here too, right? Recovery, growth, rising interest rates, that's okay because my wages are improving, because my business is doing well. That wasn't the case because we were stuck in a post-2008 world.
Yeah, the mortgage rate is not supposed to be your primary consideration when doing a mortgage, right? I mean, that's not supposed to be yes, with refinancing, you want to get a lower rate, that kind of thing, but really it's not supposed to be that much of the determining factor in this massive credit market, right? It's supposed to be about other things, and the mortgage rate's supposed to be one of those things that you can kind of set aside and say, well, we'll move it up or down to maybe influence people's decisions a little bit, but it shouldn't interrupt the entire pipeline to the point where it has spillover problems. And those spillover problems are a signal that things are not working the way they're supposed to be working.
Now, Jeff, forgive me if you've already restated this, but how does that mortgage problem disorder translate into what was called the taper tantrum?
That was where we saw the twist in the yield curve. That was where you saw, okay, the scramble for collateral pushed down bill yields because we're looking for collateral because we've got leverage positions that need funding and we're not getting them filled from the mortgage pipeline. We can't go in the TBA market with nothing. We need some kind of collateral to maintain ourselves until we can fulfill our production coupon obligations. Therefore, there was heightened demand for collateral for that and for other reasons. But, that's why the curve was twisting as it was in 2013. You have long rates rising, which was a segment of the market saying, maybe the long term won't be as bad as we thought it was going to be late in 2012 and early 2013. And then you have the short end of the curve in Treasury bills saying, we still have collateral problems here. The Fed's doing QE and they're actually making it worse. And so, eventually this could another one of those things that could accumulate to become a turning point where the monetary system just can't get out of its own way. And that's really what happened. We saw it not just in terms of what happened in the Treasury market, but also the dollar exchange rate. People, I think you might remember back in at the same time during this quote unquote taper tantrum, we had a minor emerging market currency crisis erupt too, as the dollar started to rise against a number of currencies that was not expected to be a problem, which all of these things were essentially precursors to what would follow in 2014 and 2015. So by the end of 2013, the long end of the yield curve stopped rising because it realized, oh, all that stuff going on in the bill market and the TBA market and the dollar exchange rate, yeah, that's going to be a big problem. And this inflationary recovery we thought was maybe a little bit more probable than we did last year. No, it's not going to happen.
Jeff, in this article that we're discussing that you posted on the 22nd at Alhambra Partners, you also bring up a similar situation, slightly different circumstances, that happened in 2017, latter half. If you want to discuss that, we can. I'll pull up the graph. Otherwise, I'll just conclude here with what your, I think, main takeaway is, and this is your final paragraph, quote, "The system still exhibiting key symptoms, the same, sadly, of being broken down, present day, just not nearly as uniformly and openly as it had been during the last year, 2020. That's not quite the same thing as an inflationary overshoot, though, is it?"
And that's what we're really talking about. Look, Treasury, I mean, people think of the Treasury market as, you know, that's the safe market, it's risk-free, all that stuff. Well, that doesn't mean prices are not volatile. And what we have seen periodically is that Treasury yields, especially at the long end, tend to sell off during these reflationary periods. But what does that actually mean? People, I mean, you hear it all the time from the mainstream media. It's foregone conclusion, inflation's coming, recovery, all these things. No, what it means is that the long end of the Treasury market is saying, well, things may not be as bad as they were just before that. And so right now, as the Treasury yields sell off in the long end, what that's saying is that, hey, maybe 2021 may not be as bad as 2020, which is not the same thing as an inflationary inferno and a recovery. In fact, the sell-off in the Treasury market that we're experiencing right now doesn't even come close to 2017 or 2013. So we're seeing a repeating pattern where what's going on right now is in no way unusual. In fact, this is actually typical of these kinds of periods. And what they're telling us is that things seem to be improving. But what does that actually mean? Does that mean that they're going to improve? Not necessarily. And the reason they haven't improved, at least in the prior cycles of 2013, 2017, go back before that, 2010 and 2011, is because of these warning signs and anomalies that we see build up in maybe the short end of the bill curve, or the fact that the dollar starts to rise or it doesn't fall like it should, or any number of these anomalies that we know are going to compound themselves into, and eventually, instead of recovery number one, we end up with euro dollar number 4 or number 5 or whatever the next one is on the list. We never seem to be able to get out of it. And that's really what the Treasury twist is indicating, that there's enough of those problems in the immediate space, the immediate monetary space globally, that, you know, that there's a reason this is a probability spectrum that still favors some of the less of the explosive growth kind of scenarios.
Jeff, we often refer to it as the shadow system because it's in the shadows. You can't measure it directly. You have to do it indirectly. And one of those measures is the Treasury yield curve, the bill yields, which we've been discussing. But another one might be another lens through which to view the shadow, the commodity markets. And that's where we're going to turn to in part 3, a very specific commodity, oil. We're going to talk about oil. We're also going to talk about Texas electricity and collateral. So that's where we're going to right now in part 3.